So I can't believe what's happening to the housing market right now. All right, let's go back in time, January 2022, earlier this year. What were we talking about? We were talking about all the equity we're going to earn this year. We were talking about double-digit home price appreciation. Well, fast forward to where we are today, it's a whole other story. We're talking correction and crash. Moody's once again slashed their outlook, and it's actually worse than it was a week ago. Can you believe that? So welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Randy Patrick here, putting the realism back in real estate. Today is October the 5th. Hope you are doing well. So guess what, guys? I've been working on a new document, and that I usually have as what we call lead magnet, something you can download. So basically, if you want to get your hands on this, just send me an email. I'll send it to you once I get your email. It's From Bubble to Correction, then Crash to Crisis, How the Housing Market Imploded in About 6 Months. Again, send me an email. I'll send you the documents. Just a little bit of summary, what's happened over the past few months, and giving you the reasons why we're moving forward with this correction and crash. Can you believe it? I actually can. All right. So one thing I want to point out is, I like to go for different sources and different real estate, piece of information. I got to tell you, Fortune magazine is putting out a lot of good stuff with respect to what's happening in the housing market. And, I'm looking, this is just a snapshot on their finance/housing page. We're talking every other day there's an article. And as I mentioned in the opening statement here, it looks like it keeps getting worse or actually better. I guess depends on your perspective. So what we want to talk about today really is, where things are at. And I guess they're moving faster than expected, which is really interesting. I think that's the concern for a lot of people too, is that this is hitting us a lot faster than we really realize. So the home price correction intensifies. What to expect from the market in 2023? Well, really easy here. It's, anytime the Federal Reserve moves to inflation-fighting mode, the U.S. housing market's going to be vulnerable. But when those interest rate hikes come after the U.S. home prices soared 43% in just over 2 years, the consequences will be even more pronounced. That's exactly what they're saying here. And this was kind of a Q&A interview with one of the analysts for Fortune. And basically, the question really is, how do you expect mortgage rates near 7% to impact the housing market? We were already correcting at 5% mortgage rates. Should we expect things to intensify? Well, basically, it's driven by many factors. Housing affordability. Clearly, having low interest rates keeps low payments down. Everyone's happy. But interest rates have risen dramatically since the start of the year, putting the strain on affordability. Buyers, and this is very important, buyers were already getting priced out when it was going from 3 to 4%. So now we're actually, in basically every 100 basis points, prices out, millions of Americans out of home ownership. If mortgage rates remain elevated for an extended period of time, we expect that housing demand will remain soft, new home construction will be constricted or restricted, and home prices will need to adjust downward across the country, which we already know. We already know that home construction has slowed down, and we're seeing almost a record number of unsold inventory sitting around as well, too. So a lot of the stuff that we talked about earlier, the past year, the past 2 years, coming to fruition, which is very interesting to see how this all plays out, and we get to do it in real time. So interesting comments here, but it's not just me that's talking about this. Every other video that's out there now from every real estate person is talking about the crash. I've been talking about the bubble and the crash for quite some time now. But this is the cool article. So, and again, my stress point here is that it's not guys like me who are pontificating, giving an opinion. We're talking, real economists, real analysts, people who have probably degrees in mathematics and statistics and economics and been doing this, and they work for Wall Street firms, are coming out now and talking about this. And they're not just saying, 5-10%. We're looking bigger here. So Moody's, again, slashes its home price forecast. These 210 bubbly housing markets could crash 25 to 30%. I love the comment down here saying you don't need a PhD in economics from the University of Chicago to understand that 7% mortgage rates are a threat to the U.S. housing market. And I really think that is a good statement, because once we hit 7%, it seemed that people really started to freak out and go, okay, my gosh, this is really happening now. So we're already seeing this, right? We learned on mortgage applications fell 13% last week. That's sharper than the normal decline. The difference, last week's 13% decline in purchase applications coincided with the first 7% mortgage rate reading since 2002. Basically, mortgage rates coupled with frothy home prices put new monthly payments in the upper bounds of history. When accounting for income, it's more expensive to buy now than it was at the height of the 2000s housing bubble. So it's worse now than it was, 15 years ago. The heightened affordability crunch already has economists and housing analysts alike downgrading their U.S. home price outlooks. Look no further than Moody's analytics. So here we go, guys. All right, let's take a look at this. So when a group like Moody says the U.S. housing market or U.S. home prices, they're talking about everything across the board, okay? Regionally, the results may vary, which we know. Basically, in significantly overvalued markets, they now forecast home prices will fall between 15 to 20%. If a recession hits, they expect U.S. home price decline to widen between 25 to 30% in significantly overvalued housing markets. Now, here's the thing, too. Well, you may think and go, well, those significantly overvalued housing markets, there's just a handful of them. Well, think again. These so-called significantly overvalued markets aren't isolated to just a few parts of the country. They are all over the place, and they are. So this is two graphs I'm going to show you here, or more like heat maps. So this is back from 2019, the degree of which regional home prices were overvalued or undervalued in 2019. Well, obviously the black shading there is 25% and above. The kind of purpley lavender is 0 to 25%. The bluish is less than 0. Okay, so undervalued. But the point is, there was only 3 markets that were overvalued in 2019. Just 3 markets. Fast forward to today, all right, and we're going to see that we've got a huge amount of overvaluing. So, of course, very little blue, if a handful there. A little more of the lavender purple, but look at the black, okay? Lots of dark shading there, pretty much in most of the metro locations, coastal regions, things like that. So, again, when we're this is 400 regional housing markets. They're talking about 210 being significantly overvalued, which really, if you think about it, is pretty. It's a lot. That's a lot of the country. It's a lot of the population base. It's a lot of homes in those areas that are overvalued. So what happens when there's overvaluing? Well, guess what? People don't want to buy. People can't afford to buy, and they don't want to buy, and they want to wait till they see a material change in the economic and housing landscape before they're actually going to pull the trigger and see what's best for them, which makes perfect sense, of course. So, by the way, guys, if you're not a subscriber to my channel and you appreciate the information I provide, if you could hit the subscribe button, I would say thank you to you right now. Thank you, and I'd appreciate it. If you are a subscriber, or you think you are, could you reaffirm your subscription, because I lose subscribers every day. You know the drill. Thank you very much. Okay, guys, this is what I also like about Moody's, is that firms like Moody's Analytics aren't getting more bearish simply because mortgage rates touched 7%. They're revising their outlooks because the markets are signaling that 6 or 7% mortgage rates could be around for longer than expected. And that's an important point. So we know the Fed has been raising their interest rates in order to combat inflation. They raised it 0.75 basis points last time round. They're still on the docket for maybe 1 or 2 more raises this year. So that 7% that we just hit, just over 7% mortgage rate last week, I mean, that could increase, or at least, as they're saying here, the 6 to 7 range could stabilize, and that could actually be in place for longer than expected. So it's not like we're having sticker shock now, but this could be more of the norm going forward, which would certainly continue to erode the price point and home values of the housing markets. Obviously, as long as the mortgage rates remain that high, it'll apply immense downward pressure on these frothy home prices. Over the next 6 months, he expects mortgage rates to be around 6.5%. That's up from his previous outlook of 5.5%. So really, if you think about it, if you go back to, as I said, where do we start the year off? Everything is great. Everything is awesome. People are counting on home price appreciation. They're rolling the dice going, well, if we have another double-digit increase, I've got this huge, pot of equity that I can either sell and cash out, or I could tap into with refis or home equity lines of credit or whatever. Use the money for fun, right? So, but things have changed now. We know refi applications are down, but HELOCs, which are a little different, home equity lines of credit, those are up because people are kind of realizing, okay, I don't want to spend higher interest rates and refinance my mortgage, but I can dip into it through a home equity line of credit, still get to the same place, which is extracting, what we call that tappable equity, out of your house, which is not always a good thing, especially where we're at in the marketplace. So let's be clear. This home price correction started months ago in parts of the country. The correction is already fairly steep. Which ones are shifting? So the big markets, Austin, Boise, Idaho, we're talking Phoenix. We're seeing reductions in home values. We're seeing a lot more inventory. We're seeing people pulling out, not cancel contracts a whole bit. So all these markets that have had significant home price appreciation or exponential appreciation, you're going to see those markets sort of reversing, and they're the first ones to start to drop because people just can't afford it, nor does it make sense. So that sentiment, the harder they, the bigger they are, the harder they fall, does make sense, and it sort of works that way in the housing market. Basically, those places also saw their home prices go far beyond what local incomes would historically support. So what happens in these markets is you get people relocating, and they relocate from higher priced areas, which means they can come in with cash or different expectations on what housing prices are going to be. So they're okay paying that price, or they're okay bidding and pushing up the values, because as far as they're concerned, they're actually reducing their housing costs, moving from wherever to some of these locations. And then in turn, that starts the frenzy. Everybody wants to go there. Everything picks up. And guess what? You got these places that have increased 40%, 60%, 70%, some of these markets, which are crazy. So, and again, what we're seeing here, this basically is a change in inventory according to Realtor.com. So obviously, as time goes on, we're going to see, the Phoenix, the Boise, Ogden, Utah, Austin, Texas, they're up on the top part of the chart there. You're seeing the more expensive locations suddenly have a lot more properties for sale, which, as I said, doesn't make sense. Cash out now, or stop the bleeding now, or realize that, hey, if I don't sell now, I could be in a situation where I've overpaid and I'm underwater. So again, speaking of all these type of things, so when I talk about the speed at which this is happening, because I think it's happening faster than predicted, I think that we have better access to information and data, and we can talk about this almost in a real-time level where we didn't at the last housing crisis. We were waiting to see statistics from local real estate boards and from National Association of Realtors and other comparable software and things like that. So it took a while, it was harder. Now we're seeing stuff virtually real time, which is really interesting. So that's why it's going to happen a lot faster. Also, it's the media. So like social media, things like this, whether it's YouTube or Facebook or Instagram or other social media platforms that are talking about this, the more people understand it, the more people sort of think, hey, we have some issues going here. It's going to start that kind of underground social movement where, and it's not like we're thinking of doing this on purpose. It's just that by osmosis and just the stuff you hear, you're not going to run out and buy a home right now because you kind of know that things are changing. You're going to wait to see how it plays out. So it's tough to, the social aspect is tough to actually quantify, but you can qualify it, and it's actually happening right now. So this is why, we've got a good 3 to 5 years of this happening, but I think the starting point is accelerating. And as I always mention, all the discussion points with what we're talking about, Moody's, Fitch ratings, Goldman Sachs, other people talking about, price points decreasing, etc. It's significant. And you're right. Remember the first slide, though. Home prices increased 43% over the past couple of years. So if we have a pullback, 30%, 35%, then we're still kind of netting out in the end, greater than where it started, of course. But at least it's bringing price points back down to reality, which and hopefully in turn more people can afford that new reality. So this is a cycle. Real estate runs in cycles like everything in the world. Obviously, we're looking at 2023 as to when the Fed's going to change from their quantitative tightening position and move it to quantitative easing, which means, interest rates drop and this whole thing starts over again. All right. So we're not too sure how long, this part will last, but I do believe the chaos is going to be a 2 to 3 years minimum. it's probably going to be longer. But that's kind of where we're at. And as I always say, what are we not seeing in the marketplace right now? We're still not seeing the foreclosures. All right. So if you want to find out the foreclosures, the tax deed sales, the distressed property in your backyard, your neck of the woods, go to gethousingdata.com. That's gethousingdata.com. That's my affiliate link, okay? Gethousingdata.com. You can actually check out the stuff we're talking about, and I can tell you that there's more foreclosure filings, more auctions, more things happening, more people that are needing help and aren't realizing what can happen. And, everyone thinks, well, I'll just cash out all my equity. Well, guess what? When house prices are dropping and when we're looking at 25, 30%, and this is probably a conservative estimate, it's probably going to be more than all that equity that you've kept all these years you can't access anymore and you're stuck. So that's the way things work in the real estate world. It's a sort of, best of both worlds or the worst, right? So anyway, again, I'm looking for agents. I'm looking for people to join my firm. I'm looking to expand the locations. We're doing lots of cool things with real estate. Hit me up if you want more information. Obviously, I'm wound down my short sale program. I'm working on my new program now. I've got pre-sale discounts going on. Get in now before the masses. We are at the point right now, because I remember this from the last housing crisis. We are at the point just before things started to crap out in the last housing crisis. It's kind of like, ooh, what's happening? Everything slows down. More inventory coming on. Things are on the market longer. What are we doing here? And then it slides harder and faster. All right, and that's what happened last housing crisis. People were shocked and taken aback and were not prepared. This time, we all should be prepared for what's coming. All right, guys. Once again, thank you for the views, likes, comments. Please share the video with your family and friends. If you're not a subscriber, please subscribe, and I look forward to speaking with you early next week.